Imagine two landlords in the same city, renting out the same kind of house for the same rent. One of them swears real estate is the best tax deal on the planet. The other one swears rentals are a scam because taxes keep eating the profit. Same market, same rent checks, same inflation, same interest rates. The difference is almost never the property. It is the system. One landlord is capturing the write-offs the tax code already allows and documenting them like a business. The other landlord is doing what most normal people do, which is mixing personal life and rental life together, losing receipts, trusting memory, and showing up at tax time like, "Hey, can you just figure it out?" So this script is not going to be a lecture. It is going to be a story about how landlords actually live, where the write-offs show up in real life, and the 12 biggest ones most landlords miss. And when I say miss, I do not mean they are committing fraud. I mean they are leaving money on the table because they did not track it, did not categorize it, or did not know it counted. Quick note before we get into it. This is general education, not personal tax advice. Tax rules depend on your facts and the year. Use this to build better questions and better records, then confirm details with a qualified tax pro. Now let me introduce you to 3 people, because they will keep this video grounded. Marcus is the brand new landlord. He bought his first rental, a modest place, and he is equal parts proud and terrified. Kayla is the mid-size investor. She has a small portfolio, a property manager, and she is doing well, but she cannot shake the feeling that her taxes are higher than they should be. And Omar is the accidental landlord. He moved for work, kept his old house, rented it out, and now he is learning landlord life the hard way. All 3 of them are about to run into the same truth. Rental taxes are not complicated because the IRS wants you confused. They are complicated because real life is messy, and landlords do not run their rentals like a clean little business unless they build habits. The simplest lens I know is this. There are cash write-offs, where money actually left your pocket. There are non-cash write-offs, where you get a deduction because you own an income-producing asset. Most landlords only think about the cash stuff. They forget the non-cash stuff, and that is where the big money often lives. Now let us start where every landlord starts, which is with something breaking at the worst possible time. Marcus gets his first tenant, and 2 weeks later, he gets the call. "Hey, the sink is leaking." He rushes over. There is water under the cabinet. He tightens a connection, replaces a little part, pays a plumber anyway because he does not trust himself, and then he drives home annoyed. That expense is a write-off, but here is what most landlords miss. They do not miss the fact that it is deductible. They miss it because they never capture it. The receipt disappears into a glove box. The plumber invoice is a text message link that expires. The payment came from a personal card mixed in with groceries and gas. Then tax time comes, and Marcus cannot remember if it was $90 or $200, and his accountant cannot magically guess. So the first big write-off category is repairs and maintenance. But the real lesson is not repairs are deductible. The real lesson is repairs are deductible only if you actually track them. And there is a second part of this that matters even more. Landlords constantly confuse repairs and improvements. A repair is something that keeps the property in good operating condition. Think fix, patch, restore. An improvement is something that makes the property better than it was, adds value, adapts it to a new use, or significantly extends its life. Improvements often get recovered through depreciation instead of being fully deducted right away. This matters because Marcus thinks everything he touches is a repair, because it feels like maintenance. Omar thinks everything he touches is an improvement, because he is emotionally attached to his old house, and every change feels major. Kayla has a property manager, and the manager's statement has vague lines like turnover and maintenance, which is basically a mystery box that could contain both repairs and improvements. The fix is surprisingly simple. When you pay for something at the property, write one sentence in your notes. fixed leak under kitchen sink, patched drywall and painted after move out, replaced broken window latch. That is it. One sentence turns confusion into clarity. There is also a safe harbor rule many landlords never use because they have never heard of it. The IRS tangible property regulations include a de minimis safe harbor election that can allow you to expense certain lower-cost items rather than capitalize them, with common thresholds of $2,500 per item or $5,000 if you meet certain financial statement requirements. The IRS FAQ on the tangible property regulations discusses those thresholds directly. I am not telling you to play games. I am telling you that the tax code gives you ways to keep small purchases simple, and you should know that exists when you talk to your accountant. So that is the first write-off most landlords miss, not because it is hidden, but because tracking is weak and repairs versus improvements get sloppy. Now let us move to the second category, the one landlords do not think about until something goes sideways. Kayla has a tenant who stops paying. The tenant has a story, then another story, then silence. Kayla wants to be kind, but her mortgage is not kind. She tries the friendly approach, then the firm approach, then she realizes she needs help. She pays for professional services, an attorney consult, filing fees, maybe an eviction process. She also has insurance on the property and maybe an umbrella policy because she has multiple doors and she is not trying to lose everything over one lawsuit. Most landlords remember insurance. They forget the professional side. They forget the bookkeeping software. They forget the CPA planning call. They forget the lease review. They forget the cost of the registered agent. They forget the legal consult they paid for after a tenant threatened to sue. All of that can live in the world of operating the rental, because it exists only because you operate rentals. So professional fees and insurance is a write-off category that gets missed quietly, especially as you scale because the expenses are small and scattered and you stop noticing them. The fix for Kayla was not a tax trick. It was a system. She stopped paying rental things from whatever card was closest. She created one rental card and one rental account. She made her property manager send invoices as PDFs, not just text messages. She saved everything into one folder by year. Suddenly, the same spending became visible, and visibility is what creates deductions. Now let us talk about the write-off that hides in plain sight. Property taxes. Omar is the kind of person who pays bills and forgets them instantly. If it is on auto-pay, it does not exist in his head. His rental property taxes are paid through escrow, bundled into the mortgage payment. He never sees the county bill. He never feels the payment. So at tax time, he gives his accountant a rent total and a few repairs, and that is it. He forgets the property taxes completely. This is so common, it is almost funny. If you pay property taxes through escrow, you still paid them. They are still part of running the rental. But you have to actually capture them. The easiest habit in the world is a once-a-year rental snapshot. For each property, pull your mortgage statement and your county record and capture the annual totals that matter. Property taxes, insurance, HOA if it exists, mortgage interest. If you do nothing else but capture those four, you will already stop missing money. Now, let us talk about the write-off that feels obvious, but gets missed because it is too normal. Labor, contractors, property management fees. Marcus hires a handyman for a turnover. Kayla has a regular cleaning crew. Omar pays a landscaper because he lives in another city now. These are all write-offs, but landlords miss them in two main ways. First, they forget the small vendor payments that happen through apps, cash, or quick transfers, the ones that never produce a clean invoice. Second, property manager fees often get netted out, and landlords mistakenly think, if I never touch the money, it does not count. Here is the clean mental model. Your rental earns gross rent, then it pays expenses, then you receive net. So if a property manager collects rent, takes their fee, pays a plumber, and sends you what is left, you still had the gross rent and you still had the expenses. Netting does not erase the write-offs. It just hides them from your bank account. For mid-size investors, this is where good bookkeeping separates the pros from the stressed. You want the monthly owner statement, you want the line item detail, you want vendor invoices attached when possible. You want to be able to answer a simple question without guessing. How much did I pay for management? How much did I pay for maintenance labor? How much did I pay for turnovers? Now we arrive at a category that creates myths and arguments, because people mix personal rules with rental rules. Interest. Most landlords understand mortgage interest on a rental counts as an expense tied to the rental, but the category is bigger than mortgage interest. Marcus uses a credit card for supplies during a turnover and carries a balance for a month. That interest exists because of the rental purchase. Kayla uses a line of credit to cover a down payment while she waits for a refinance on another property. That interest exists because of the rental acquisition. Omar pays points and loan fees when he refinances. Some costs may be treated like interest over the life of the loan depending on the details. The thing that makes this category work is tracing. You want to be able to show what the borrowed money was used for. This is not about being fancy, it is about being clean. If the funds were used for the rental operation, keep the receipts, keep the statements, and keep the notes that connect the dots. Separate accounts help because you stop creating mystery. Now, pause for a second, because this is where most landlords think they have captured everything, and then they wonder why investors talk about real estate like it is special. They think rent minus expenses equals taxable income. That is not the full story. This is where the biggest non-cash write-off enters the room. Depreciation. Depreciation is the tax code acknowledging something landlords already know. Buildings and components wear out over time, and you are allowed to recover the cost through deductions. The IRS explains depreciation as a way to recover the cost of business or income-producing property through depreciation deductions, and it is the core of how rental property deductions work over time. For residential rental property, the common recovery period under MACRS is 27.5 years. The IRS rental publication discusses that treatment for residential rental property. Here is why that matters in real life. Marcus thinks his rental made money because he has cash in the bank. But when he sits down with his tax return, he learns that taxable income is not the same as cash flow. Depreciation is a deduction that can reduce taxable income even though no cash left his pocket that year for that deduction. So Marcus can have a year where the tenant paid rent, he paid the normal operating bills, and he still has money left, but the taxable income is much lower because depreciation offset part of it. This is one of the reasons real estate builds wealth. You can be paying down debt and building equity, while the tax return shows much less taxable income than the cash flow suggests. Now here is what mid-size investors miss with depreciation. They often take depreciation on the original building but forget to properly track later improvements. A roof replacement, an HVAC system, a new fence, a major exterior project. Those are often improvements that get added to basis and depreciated, and if you do not track them, you can end up paying for an improvement and never claiming the full deduction pathway properly. So Kayla started keeping an improvements log per property. Not a spreadsheet masterpiece, just a simple record that says what was done, when, and how much. That one habit can prevent years of missed depreciation. Now let us expand the depreciation story, because this is where the conversation gets interesting fast. A property is not one thing. It is a collection of things. There is the structure, there are components, there are certain items that can have different recovery periods than the main building. This is where cost segregation enters the conversation and where some investors accelerate deductions earlier, depending on the year and the rules in effect. The IRS depreciation publication discusses special depreciation allowance concepts and MACRS rules generally, but whether and how an acceleration strategy applies depends on the property and the year. The reason you talk about this in a viral YouTube way is not by drowning people in terms. You talk about the feeling and the outcome. Kayla buys a larger property. She wants to keep more of the cash flow because she is using it to buy the next deal. She hears about breaking components into shorter life buckets so deductions arrive sooner. She learns this is not a trick. It is an accounting method that can be used when properly supported. Then she learns the bigger truth. Even if she does not do a formal study, she should still be thinking like a business owner. She should keep detailed purchase documents, detailed rehab breakdowns, clear invoices, because clean records give her options later. So, depreciation is a write-off category that most landlords underuse, misuse, or fail to track properly, and it is one of the biggest reasons two landlords can have wildly different tax outcomes. Now let us pull back to cash write-offs again, because there is a category that gets missed simply because it feels too boring to matter. Utilities and services the landlord pays, water and sewer in some markets, trash, gas in a multi-unit where it is not separately metered, electric for common areas, lawn care, snow removal, pest control service contracts. These are not glamorous, and that is why they are missed. Marcus forgets them because they blend into life. Kayla forgets them because the manager pays them and nets them out. Omar forgets them because he moved and he still has an old utility account on autopay he barely looks at. But they count, and over a year, they can be meaningful. The habit is to treat every recurring property service like a subscription that belongs to the property. Then it becomes easy to capture. Now let us talk about a category that sounds like it belongs to big companies, but it belongs to landlords too. Advertising and tenant placement costs. Marcus lists his rental online. He pays for premium placement or pays for a service to syndicate the listing. He pays for tenant screening. He pays for background checks. He pays for a lockbox. He pays for photos, or he pays someone to do a video walkthrough. Then he forgets all of it because it happened in a busy week when he was juggling phone calls and showings. These costs are part of getting the property rented, which is the point of the property. For Kayla, leasing costs might include broker fees, leasing commissions, or renewal fees if her manager charges them. For Omar, the cost might be travel to show the unit because he does not have a manager and he is driving back and forth like a maniac. This is a category that gets missed because it is seasonal. It spikes during turnovers, then disappears, so it does not feel like a normal expense. The fix is to build a turnover folder, even if it is just a digital folder. Every time a tenant leaves, all listing and leasing costs get saved there. Then at tax time, you are not guessing. Now we hit a category that is small individually and enormous in aggregate. Supplies and small tools, paint rollers, brushes, drop cloths, screws, outlet covers, plumbing parts, light bulbs, filters, batteries for smoke detectors, caulk, cleaning products, door stops, grout. Little things you buy constantly. Most landlords do not miss the fact that they bought them. They miss them because they never separate them from personal spending. Marcus goes to a big box store and buys a mix of rental stuff and personal stuff in one receipt. A filter for the rental, a curtain rod for his house, snacks, a storage bin. Now that receipt is useless unless he splits it out. Kayla has the same issue at scale. Her handyman buys supplies, gets reimbursed, and the reimbursement is recorded as one number with no detail. The fix is simple, and it is not about being perfect. Do separate transactions when possible, even if it takes an extra 30 seconds at checkout. If you cannot, take a photo of the receipt and circle the rental items, then save it in your rental folder. This is also where the IRS de minimis safe harbor conversation matters for some landlords because the rules can allow you to expense lower-cost items rather than capitalizing them, depending on your situation and elections. The IRS Tangible Property FAQ discusses the safe harbor threshold concept. The practical takeaway is not, go memorize regulations. The practical takeaway is, stop throwing away small deductions by losing receipts and mixing purchases. Now we move into a category that people avoid because they are scared of it, but it is one of the simplest to do cleanly. Mileage and local travel for rental activity. If you manage rentals, you drive. You drive to the property, You drive to meet contractors, you drive to pick up supplies, you drive to inspect a turnover, you drive to the bank, you drive to your property manager office, you drive to show a unit if you self-manage. Those miles add up, especially for investors with multiple properties. Most landlords do one of two things. They track nothing. Or they try to recreate a year of driving from memory in April, which is basically fiction. So here is what Kayla did, and it changed everything. She stopped thinking of mileage as a tax trick and started thinking of it as a business log, like any other business. She used a mileage tracker app and labeled trips with purpose, visited property for inspection, met plumber, picked up materials for turnover. She did not try to count every tiny trip perfectly. She just created a consistent system. Now let us talk about a category that is closely connected to mileage and often misunderstood. Home office. The home office is not about being dramatic. It is about having a legitimate place where you run the administrative side of your rental activity. The IRS home office guidance emphasizes regular and exclusive use rules for qualifying areas, and the IRS publications go into detail on how business use of home works. Here is the human version. If you have a specific space where you regularly do rental work, like bookkeeping, tenant communication, lease admin, vendor coordination, and you meet the requirements, it can create a deduction for business use of home. And it can also strengthen the logic that certain trips from that administrative base are business travel rather than personal commuting, depending on your facts. The reason landlords miss this is fear. They have heard people say, "Never take the home office deduction." That advice is outdated and oversimplified. The better advice is, take deductions you qualify for and document them. So Omar, the accidental landlord, sets up a small desk area used only for rental admin. He keeps it clean. He uses it regularly. He documents it. He does not get cute. It becomes part of his rental business records, not a gray area. Now we come to a write-off category that matters more as your portfolio grows, and it is one landlords rarely label correctly. Bookkeeping, software, and admin systems, accounting software subscriptions, tenant screening tools, document signing tools, mileage tracker apps, cloud storage for leases, even a portion of a phone plan if it is used for rental operations, depending on how you run things and how you document business use. Kayla used to treat these as random business expenses. Then she realized they were part of the rental engine. They exist because she runs rentals. They help her earn income and manage risk. This category is missed because it is not tied to a specific property repair. It feels like background noise. But background noise becomes a meaningful deduction when you stack it across months and years. Now we need one more write-off category that is extremely common, but people either forget it exists or they categorize it wrong. Education and training that is directly tied to operating rentals. I am not talking about vague motivational seminars. I am talking about landlord-specific education that helps you operate, manage, comply, and run the business side of rentals. Marcus buys a landlord screening course because he had a bad tenant, and he never wants that pain again. Omar pays for a consult about local landlord-tenant rules and compliance because he is in a new state now, and he does not want to step on a legal landmine. Kayla goes to a local real estate investor group and pays for a workshop on property management systems because she is scaling and she needs her operations tighter. If the education is tied to your rental activity, it can be treated as a business expense. The key is that it is connected to maintaining or improving skills for the rental operation, not launching an entirely new, unrelated business. Your tax pro will help you draw that line. Landlords miss this write-off because they do not save the receipts or they assume education does not count. Now we have covered many cash write-offs, the ones where money left your pocket. But the last category is the one that gets shared the most because it feels like a loophole, even though it is simply payroll. Paying your kids or family members for legitimate work. If a family member does real work for the rental activity and you pay them a reasonable amount for real tasks, that wage expense can be a rental business write-off. The reason investors talk about it so much is because it can move income from a higher tax bracket to a lower tax bracket in the household, and it can create a structure where the work your family already helps with becomes documented and legitimate. The key phrase is legitimate work. Photos and videos for listings, cleaning and turnover help, landscaping help, admin tasks like organizing receipts and scanning documents, social media posting if you create content around your rentals. If it is real, document it. A simple job description, a simple time log, proof of payment, work product when possible. This is where Marcus had a light bulb moment. His teen already helped him during turnovers. He already had her taking photos and making short clips. He already had her helping clean baseboards. It was real work. The only thing missing was structure. Once he added structure, the same reality became a legitimate expense category. Now let us connect the whole story because viral videos do not end with "that is the list." They end with a transformation. Marcus started the year feeling like taxes were a punishment for buying a rental. Kayla started the year feeling like she was doing well, but somehow still leaking money. Omar started the year feeling like renting his old house was passive, until the first midnight repair call reminded him nothing is passive unless you build systems. All three ended up learning the same lesson. The biggest rental write-offs are not hidden. They are missed because landlords do not track, do not separate, do not label, and do not treat their rental like a business until it hurts. And the biggest non-cash write-off, depreciation, is missed because people do not understand that taxable income and cash flow are not the same thing. And the tax code allows you to recover the cost of an income-producing building over time, which the IRS rental and depreciation publications explain. They also learn that losses may be limited by passive activity rules, and there is a special allowance for landlords who actively participate that can allow up to $25,000 of rental real estate loss against non-passive income in some cases, as described in the IRS instructions for Form 8582. That matters because when you start taking the write-offs correctly, you may create paper losses from depreciation, and knowing how those losses are treated keeps you from getting confused or disappointed. So here's the clean closing that makes people save the video and share it, because it gives them an action plan without making them feel stupid. If you are a new landlord, do not try to become a tax expert. Become a tracking expert. Save receipts, separate rental spending, download your manager statements, write one-sentence descriptions on repairs. Make sure depreciation is set up correctly from the start. If you are a mid-size investor, your win is in tightening the system. Clean statements, clear categories, improvements logged per property, vendor invoices attached, mileage tracked, home office documented if you qualify, software and admin captured, leasing costs captured during turnovers. And if you want the simplest test for whether you are missing write-offs, here it is. If someone asked you right now to show your rental profit and loss by property with receipts and statements to back it up, could you do it without panic? If the answer is no, that is not a shame moment. That is a system moment. Because the landlords who feel like real estate is the best tax deal are not magical. They are organized. If you want, I will give you a simple one-page landlord tracking sheet that matches everything you heard today. It is not theory. It is the exact categories and the exact questions to ask your accountant so nothing gets missed. If you want it, comment the word checklist. And if you know one landlord who is overpaying taxes because they are disorganized, send them this video because the fix is not complicated, it is consistent.